Day trading using options can be a really good way to capitalize on short-term stock movements and limiting your risk exposure. And when you use the right strategies and the right tools, you can make the most out of this experience by taking advantage of the leverage and the loss limiting capabilities that options provide. So in this video, we're going to discuss how to use near month in the money options for day trading, the benefits of that, and how to maximize your returns. So first, let's have an overview. Options trading is where you have the right to buy or sell a stock or some underlying at an agreed upon price by a certain date. And unlike stocks, options have time limits, so they expire after a certain period, usually a month or more, but a lot of people choose very close expiration dates. Your day trade, it involves taking positions in the market that are open and closed quite quickly. Sometimes people do it within minutes. And this allows you to quickly capitalize on those short-term movements. Now, options trading, it offers several advantages to day traders. First off, the potential to provide a greater return on investments than stocks since they come with leverage and can be sold at a higher price than what you paid for them. Second, the time value component of options means that you can limit your losses if the underlying stock does not move in your favor. And finally, when you trade options, you don't need as much capital up front as you would with stocks because the cost of buying and selling options is lower. So this means that day traders can get into and out of positions quite quickly without having to commit too much capital up front. One of the biggest advantages is they have the potential to provide a greater return on investments in stocks. And this is because options come with leverage, and those contracts can be sold at higher prices than what you paid for them. So let's say you bought a call option on ABC stock for $1 a share, strike price of $100, and the stock is currently trading at $105. So this means that you have the right to buy 100 shares of that stock at $100 per share anytime before that option expires. So if you exercise your option and you sell your shares immediately and that stock goes to $110, well, you make a gross profit of $10 per share or $1,000. So you compare that to buying the ABC stock outright at $105. Well, that's only going to make you $500 if the stock goes to $110. Now, there's other factors, of course, that are involved in all this, but this is just a high-level view. So options will provide leverage profits without having to put too much money up front. Another big advantage is there's a time value component, and that means you can limit your losses if the underlying stock doesn't move in your favor. So time value is how much of the premium is based on the time remaining in the options contract. The more time that is left before an option expires, the greater its value. And the reason is because traders are usually willing to pay a higher premium for longer contracts. That way they have more of a chance to profit from any positive change in the asset. There's more time. Another advantage, you don't need to risk as much capital up front as you would with stocks because the cost of buying and selling options, that premium, is lower. So for example, let's say you want to buy 100 shares of XYZ and it's currently trading at $105 a share. You only have $10,000 to invest. Well, if you were to buy that stock outright, you can only purchase 95 shares. But if you were to buy put options on XYZ stock, let's say the strike price is $105, a premium of $2, you could actually purchase 10 contracts for $2 a share or $2,000. There's a few challenges, of course, when you start looking at options. There's expiration dates, and that's one of the biggest challenges. And that just means if the underlying stock does not move in your favor before that option expires, it expires worthless. So to overcome this challenge, you got to be aware of the expiration date of your options and trade it accordingly. So if you're holding an option that's close to expiration and that underlying stock has not moved a whole lot, you may want to cut your losses and move on. We also got to look at the lack of volume. Now, liquidity is important when you're trying to get in and out of a position quite quickly. So if there's not enough volume, it could be difficult to get out of your position at the price that you want. This challenge could be overcome by doing your research and only trading options with sufficient volume. And you can easily check the volume of an option by looking at the bid-ask spread. The narrower the spread, generally, the higher the volume and the more liquidity in that option. Finally, another challenge is they can be quite complex trading options, and especially true if you're new. Some traders just don't have that level of understanding that's required to trade them successfully, and it could lead to mistakes. It's a challenge that you could overcome. Just do your research, understand exactly how they work before you start trading them. There's a ton of resources online that can help you learn about trading. There's a whole bunch of resources here on our YouTube channel. Talk one more time about the time value. When we talk about option premiums, they have two main components, intrinsic value and time value. Intrinsic is that difference between the option strike price and the current market price of the stock. Time value is the amount that you pay for an option beyond its intrinsic value, which reflects the risk of expiration and other factors that are associated with options. As that expiration date gets closer, the time value component of an options premium begins to deteriorate, and day traders need to take this into account when you enter and exit your positions. Also, when you trade options, there's a bid-ask spread, and that refers to the difference between the price at which an option can be bought and sold. And the wider the spread is, the more difficult it could be to get in and out of position quite quickly, as buyers may not be willing to pay the ask or sellers not willing to part with their options at the bid. At NetPicks, when we're looking at pricing, we always start with the mid-price between the bid and ask. So strategies, there's a variety out there you can use, and one strategy is to buy near month in the money options, with the expectation that they're going to generate a large move in price quickly. Now, this strategy carries a high degree of risk because option premiums have an expiration date. Prices can move quickly in both directions. Another strategy is writing out of the money options. And that way, you would collect the option premium for selling the option. But you can also potentially incur losses if the underlying stock moves, right? So this strategy also carries a high degree of risk, and it does require an understanding of how prices could react in market conditions. So many different ones out there. Finally, some traders will opt for strategies like spread trading, and that involves buying and selling multiple options with different strike prices. This type of strategy, a little bit different. You got to understand them. But again, they're easy and to learn, just not always easy to implement. When you day trade options, they're best done with near month in the money options of liquid stocks. Very little time value left, and a delta close to 1 makes them pretty ideal for short-term trading. So as we approach expiration, that premium is increasingly based on its intrinsic value, so it allows us to closely track the underlying stock movements. Near month options are more heavily traded, and they are more liquid than the longer-term ones, meaning they could have smaller bid-ask spreads. And for day trading purposes, these features make near-month in-the-money options of popular stocks the ideal choice for day trading. Let's talk about lotto plays. These are options. It's a very aggressive strategy. It involves buying out-of-the-money options in the hopes of making a quick return because out-of-the-money options are cheap. This type of trading, it's potentially profitable, but it carries a high degree of risk and could only be attempted by experienced traders who understand the risks that are involved and have those financial resources to support the potential losses that will come. Now, since a lotto play with options focuses on out of the money, there's a high chance that these are just going to expire worthless, right? That means if the underlying asset doesn't move in the desired direction, or if it just moves a little bit, the trader's going to lose the entire amount. For this reason, you got to have a sound exit strategy in place before entering into any lotto play. Now, it could be right for you if you're experienced and you understand the risks and you have the financial backing. But this type of trading is not for everyone. Even experienced traders can find themselves in way over their heads, especially if they don't have a way to get out. So if you're thinking about employing a lotto play, and they're actually pretty popular on Twitter, make sure you fully understand all of the risks that are involved. Thanks for watching the video. Any questions or comments, make sure you pop them below, and make sure you grab this options trading download. Free. The link is above and below. We'll talk to you soon.